Hey traders, welcome to Charts and Coffee. Happy Monday morning, everybody. Taking a look at the continued sell-off we've been seeing from Friday. One of the things that I know everyone's got on their mind is, okay, Rog, when does this end? And let's remember, trading is never a prediction. I know there's a lot of uncertainty, but when we embrace becoming traders, we embrace something that most people aren't willing to do. We are willing to embrace uncertainty and managing risk in the process. So in the meantime, question might be, Rog, what happened? Wasn't Friday's sell-off enough? So we're going to do a couple things. Number one, it was apparently a pretty rough open in Japan. So if you take a look at something like the Nikkei, you'll see it was a rather bumpy open in Japan. And, obviously we inherit a lot of the weakness that will come before the U.S. session opens. Remember, Asia opens every new trading day by 9 p.m. Eastern. For us, that will be Sunday. They're already open. You can see the sell-off. Pretty dramatic day. This is the NKD futures reflecting what's happening in the Nikkei. And so when you keep moving forward into the U.S., in many ways, we're probably inheriting some of that risk aversion. But this actually reminds me not of 2020. 2020 was a pandemic. Let's just take that off the table. This actually reminds me of the monetary policy tantrum that was thrown in 2018. So the brain's always trying to find some sort of point of reference, right? And I think we all do that. We're trying to find some sort of point of reference where have we seen this before and how did that resolve, right? So let's do this. Let's go over and jump back so we can take a look at more data than just the last handful of years. And I'm going to take us all the way back like a DeLorean in the time machine. We're going to go back to 2018 Q4. All right. So what happened back in here? See the sell-off here? Okay. So what happened in Q4 of 2018? And this is far more similar to what we're dealing with now. And it may not be the same scope. But please don't go compare this to the pandemic reaction of Q1 2020. Look at 2018 Q4. All right. So what happened here that's so much different than 2020? This is where the Fed Fund futures had priced in a pause in the rate hikes. Now, remember, we were in a rate hiking cycle going into that period of time. And then we expected Powell and this is Powell Green, brand new as the Fed chair. We expected Powell to pause. And you can see all the hesitation here because at this point, from October forward, equity markets, this is the S&P, by the way, equity markets were saying, hey, you've hiked enough. Please no more hikes. We're ready for a pause. We're telling you via the Fed Fund futures. We're telling you via the chop. We didn't mind the hiking cycle. We get that it's necessary, but stop. And he didn't. And that's where you see this move right here. So take a look at the sell-off. This is when the Federal Reserve ignored the monetary policy expectation and the market threw a tantrum. And that's really where we need to remember, if anywhere, that we're sitting. Now, this was up until the pandemic reaction. This was the swiftest sell-off in terms of scope that we had seen in modern markets. And it really sent a panic. And then what happened to put this V bottom in? Jerome Powell went on Bloomberg. It was a 3-panel informal discussion televised on Bloomberg. And he said, the Federal Reserve is going to pause. Wasn't even an official monetary policy meeting. He just said, we're going to pause. And then began actually one of the swiftest rallies at that point, going into 2019, known to humans. Okay. So fast forward to where we are today. Now, not every single sell-off and not every single monetary policy disappointment is going to play out the same, but go back to that period in time. And remember, the Fed can do two things. One, they can be pretty vocal. We've got Barkin speaking this week. We've got Daly speaking this week. Jerome can have an interview at any particular time if he needs to communicate a shift in monetary policy, because we're in a strange window right now. August does not have an FOMC meeting. It's not until the 18th of September. There's always, those of you that remember trading in the late 90s, remember the surprise rate cut? How many of those did Greenspan do, right? How many of those did Greenspan surprise the market with? I'm not saying we're going to get a surprise rate cut, but it would not be out of the realm of possibility for Jerome to do what he did in 2018 to 2019, Q4 to Q1, and kind of publicly say, yeah, we're gonna start to cut, right? Just to assure the market of what they already expect. What was really unusual is that we weren't really upset about the hold July 31. When I say we, I mean collectively traders and investors. We weren't really upset about the hold on the July 31 meeting. What we were upset about, and what this is really a loss of faith in Powell, is we're thinking, hey man, you have all the data. You should have known the jobs data was going to look as awful as the non-farm payroll, average hourly wages, and the unemployment rate was going to look last Friday. The fact that you did not cut July 31 in some sort of anticipation of the broader markets receiving this fairly terrible bad news, when one of your mandates is employment, right? Inflation and employment. This is a loss of faith. That's it, right? Now, please remember, I wish I could bring up I think I did yesterday. I can't remember if I brought up my Twitter feed yesterday, but this is where I want to remember that my job as a trader is not to forecast and panic over, recession. What are all the buzzwords right now? Recession, the Federal Reserve dropped the ball, fill in the blank, right? Two things I'll recommend everyone do. And I put this in my newsletter this week. One, remember, this is where we are on the S&P for the year. Yes, it's a pretty big sell-off, but as I showed you in 2018, it's not that different, right? This is a loss of faith in the Federal Reserve's monetary policy pace, okay? All right, number two is, let's remember, one of the things that we do in the Sector Secrets Mastery is we built a longer-term portfolio. So, when I see moves like this, let's move this over and show you another time frame, because I've got this running on my other screen. So when we have weakness like this, what I love to do, come on, there we go. I'm trying to get this chart to slide on over. There we go. What I love to do is I love to move over to a weekly time frame. And in this weekly time frame view, and I'll actually show you exactly what we've done since May and June, or was it May and July? But May and June, we built a couple positions. Not everything is panic. That's what I tried to relay on the Friday video. Not everything is in a panic. Not every time frame is in chop or bearish chop or a downtrend. There are a lot of things that look really good. So in May, or I think it's May and July, were our two big months for buying a lot of longer term positions. We're long Mondelez, right? But on what time frame? The weekly. We're long McDonald's. But which time frame? The weekly. We're long from 250, 330 in McDonald's. I'm drawing a blank. I think we're long Pepsi. Yeah, I'm drawing a blank right now. But please remember, there's always opportunity somewhere. And that's really what I was trying to convey on Friday's video. And I think I opened it up by saying, look, we're never going to make money and manage risk panicking. There's no reason to panic. And I hope just a little reflection of, oh, Rag, we've seen this kind of monetary policy disappointment before. Yes. And then in the aftermath of that, we had one of the strongest rallies known to humans afterwards. So that's what I said. At some point, my longer term time horizon, right? My longer term time horizon to the end of the year, right? I'm bullish. Am I bullish right now? No, I need a setup, right? I need relative outperformance. And you might say, okay, but Rod, what about in the meantime? Okay, I'm never going to talk about what we could have done or should have done, because frankly, that's not why you're tuning in. If you want all this coulda, woulda, shoulda, turn on television, right? But here's what we have. Here's what we had Friday. We had into Friday long calls in healthcare, which we got out of when we hit a target and then it pulled back to break even. We still have long calls in Coke. That's a staple. That's one of the strongest stocks in staples, right? So we're still long Coke and we're actually long utilities. So when we start to see increased volatility, even before the sell-off, one of the best things to do is figure out when we're in confusion. Remember, not only is fear is not confusion, by the way. Volatility is confusion. Volatility is chaos. Downtrends are not necessarily the problem. It's either give me the uptrend, give me the downtrend, but don't stay in that volatile chop. That's what we've got right now. So staples are going to benefit. Utilities, XLU names, names like NEE, Southern Dominion, Duke, names in staples like Coke, Philip Morris, Altria, even Colgate starting to wake back up again. So these are things that we'll gravitate to. And this is twofold. One, we know these are defensive. They're always going to be defensive. That's their job. But two, when you take a look at the normalized performance, this is not something that came out of left field. This has been something that we've been seeing consistently, right, through July. And one of the things that I want to remind everybody is if you're waiting on the VIX or some sort of volatility gauge to tell you things were volatile, remember, they are really lagging. If you watch the video from Friday and you look at the way we look at daily time frame plus the volatility on that daily, we've been in an increased high volatility environment. Forget the VIX. We've been in an increased volatility environment since the end of July. You can see right there, July 2-4, we started persisting. If July 2-4 really, then it calmed down a little bit, but then take a look, July 3-1. All right, so we've had multiple sessions that were already sounding the warning bell, and that's why staples and utilities look so good to buy the dip on, right? So if you follow the process of money tends to flow a certain way when volatility increases. How do I know if volatility is increasing? We have to have a real-time assessment, right? Not waiting for a futures contract like the VIX to wait for the SPX options to do something. And right, I don't need that trickle down result. I want to know live on the chart that I'm looking at. Hey, is this within normal volatility or not? Take a peek. This is the 24th on the NASDAQ. We've had heightened volatility on the NASDAQ easily since the 24th or the 30th. So I'm not saying that forecast to move to the downside, but that type of increased volatility does tell us something is, I don't want to say wrong, but something is chaotic under the hood, right? So if you learn to map these out and recognize them, look, we weren't in tech. We weren't in financials. We weren't in things that were high volatility. We were in things that benefit or things that were enjoying a lot of flow. I still like healthcare, but I know that healthcare as a part of the Dow, as a part of the S&P, is going to have to work so hard, even though there's inflows into healthcare and it's one of the better sectors, it's going to still be dragged down by the broader averages. Yeah. But if someone were to say, Rob, where are we going to be by year's end? Yeah, I'm not in any way bearish longer term. Am I going to be bearish as a day trader? Probably. Am I going to be bearish as a short-term swing trader? For the first couple of days of this week, it's going to be the prudent thing to do. Or stay flat, right? Flat is a position. We can wait. Or take a look at those weekly time frames and find those names that are on sale. I mean, the S&P right now is triggering a mean reversion on the weekly. If you're looking for those opportunities to build positions, look, sales come disguised as panic on Wall Street, right? So if we can keep that in mind, we can still be tactical and find a time horizon where we can absorb the volatility and take advantage of what is very likely to be a resumption of strength, right? I showed you in 2018, we've seen what happened in that 2018 to 2019. Even if you're looking more short term, take a look at what happened in April. Right? We had a pretty decent little sell-off in April as well. This one's happening faster, but it's not much larger, right? And what happened after that? We actually pierced in a similar way, just slower, right? But we pierced in a similar way the anchored VWAP. You can see right there. We chopped around it for a while. And then, oh yeah, we remembered the Federal Reserve is going to cut rates and the world isn't coming to an end. Remember, gang, fear sells. Fear sells. And what I always want to tell folks who want to talk fear is I don't care what you think. Did you get folks short? Are you long puts? Right? That's all that matters. That's why I say in an environment like this, talking trader to trader, got to talk our book. What else is there to talk about? What are you in, Rog? Right? That's going to speak volumes about what it is you're describing I do as well. So that's why I mentioned, what we're doing. All right. So with that being said, this is where we are as we kick off the morning. Dow, Russell, NASDAQ, S&P, they have not largely moved together throughout the year. In fact, we saw a lot of, before the sell-off, Dow moves higher, NASDAQ moves lower, and vice versa. But at the end of the day, now they're in agreement. We have widespread risk aversion. So we'll see the way in which price action responds to the VWAP, as you can see here, right? We'll take a look at that, and then we'll wait for some sort of stability in that area. I'd love to see a Darvis in that area, and I'd like to see, again, a recovery back over that level. So until that happens, really the two extremes in terms of time frames are going to make sense. I'm going to be focused on the weekly time frame and bargain hunting. As I like to say, there's a lot of things on my wish list that I want to buy. And so I'll start looking at my wish list, making sure that the trend is not down. Apple is, and take a look at Apple for a moment. Apple topped out around 237, is trading around 217 right now. It's actually doing pretty well, all things considered. I'd like to look at something like Apple. All those names that you've been wanting but don't want to chase higher. Like I said, Wall Street's the only place they throw a sale and nobody comes, right? But sales will always look like panic. So when everyone else is freaking out, you're going to feel kind of funny going, well, this is on sale and that's on sale and that's on sale. Do people think that Microsoft is not ever going to recover? Right? I may not be a huge fan on the daily, but we're making a mean reversion right now on the weekly. Does anyone think that Microsoft is not going to be heading higher at some point in the future? Again, if your time horizon is long enough, you can withstand a lot of the volatility day to day because you're looking at a weekly time frame. So those are all things to keep in mind. All right. The other question that people have been asking is, are we going to hit the circuit breaker? We've got to be down 7% to hit a circuit breaker. So we've got to be down 7% on the session. So if and when that happens, they halt trading for 15 minutes. Again, so what you got to figure out is, are we down 7%? And that's how the circuit breakers happen. Look, the last time we hit circuit breakers were 4 days in March of 2020. Do I look at this as the pandemic type sell-off? I really don't. Like I said, I think a lot of people are looking at, and this is really just not apples and apples. It's apples and kumquats to compare now to 2020. It's just a basic misunderstanding of why we're down. This is not a pandemic. The world's economies are not shutting down. This is a loss of faith in monetary policy. This is a loss of trust in the chair. This is 2018, gang. This is not 2020. And if you take a look at the circumstances around it, oh, okay, that makes sense, right? That makes sense. So that's the way we want to look at the way in which this sell-off would relate to previous monetary policy related sell-offs, and then the end result, which is the Federal Reserve can't snap their fingers and change the circumstances of a pandemic, but the Federal Reserve can snap their fingers and change monetary policy. If Jerome Powell wanted to cut rates today, he could, right? And so keep in mind, very, very different. Do not liken this to 2020. That's completely misguided, right? Okay. So in terms of, again, what we want to do, keep a short-term time frame, either day trade today or short-term swing, or go shopping. Take that watch list of stocks you've been wanting for the last year or two and say, look, this might be the best sale we've seen likely since possibly October of last year, which is a time where we added to our longer-term buy and hold portfolio in the Sector Secrets Mastery. So keep your head up. Look for the opportunity. It may not be in places that it's been before, but we adapt because as we talked about yesterday in the Top Tier Outlook show, your edge is your watch list, gang. It's not your indicators. It's not your strategy. Your edge is your watch list. Build a good one. I'll see y'all tomorrow, same time, same station. Be good to each other, gang.